I'll recognize gentleman from North Carolina, Mr. Moore, for 5 minutes.
Thank you, Mr. Chairman. To our witnesses, for too long, banks and credit unions, especially the small community institutions, have struggled under a one-size-fits-all regulatory framework. Regulations, I would submit, should be tailored to the size, the complexity, and the risk profile of each institution, and not imposed uniformly across the board. But today, financial institutions, regardless of their size, are forced to navigate complex and costly compliance burdens. Under this system, small businesses and rural communities have lost access to affordable capital and essential banking services, which prompts a couple of questions. First, for Ms. Flowers, what is at stake if we do not return to a tailored, risk-based regulatory approach?
What's at stake is economic growth. I mean, banks are fueling the economic growth of our country, and as I mentioned at the outset, banks of all sizes play an important role in that. When you have undue compliance burdens in particular that are imposed through the supervisory process, even aside from regulatory tailoring, when requirements are being pushed down onto smaller banks that are inappropriate for them, you're increasing the burden without an offsetting benefit. So I think it's important to free those institutions from supervisory expectations that are unmoored from a legal or materiality standard and are just based on the reviews of what the biggest, largest peer banks are doing and pushing those down onto smaller banks.
So supervision must be right-sized, not dictated by arbitrary thresholds or rigid frameworks disconnected, I guess you'd say, from actual risk. Mr. Radcliffe, would further tailoring of regulations for community-based financial institutions help reverse the trend of bank closure?
I believe it would, and that's sincerely my hope, and that's why I support the Taylor Act in particular.
Thank you. During the previous administration, Biden regulators injected political agendas into bank supervision, particularly by pushing climate-related or digital asset-related risk requirements far beyond what safety and soundness concerns demand. These actions have real-world consequences: less credit for small businesses, fewer mortgage options for families, and reduced innovation into the American economy. Mr. Taylor, could you speak to how the politicization of reputational risk has created legal risk for the banks?
Well, I think it's created legal risk for those banks that have either that have permitted themselves to be persuaded by the regulators that politically exposed persons or other disfavored industries should be cut off. And I think it was said here earlier before, there is a sauce for the goose, sauce for the gander issue around these because we have election cycles, and so today's favored industry could be tomorrow's disfavored industry. My own view is we should take political views out of banking.
All right. So Ms. Taylor, let me ask you this. Do you think there's a credible, objective way to measure reputational risk, or is there inherently just too subjective to remain part of the supervisory framework?
It's inherently too subjective. It's new. Let's remember how new it is. It didn't exist 20 years ago. It doesn't add anything to existing risks. For example, Bank Secrecy Act, anti-money laundering, terrorist financing, they're all already covered. And I just think that experience has shown that it cannot be objectively supervised or managed.
At the end of the day, we need a federal financial regulatory system that works for the American people, one that's transparent, accountable, and proportionate. Mr. Radcliffe, in your experience, what impact would returning to an 18-month exam cycle for well-managed institutions as proposed in the Trust Act have on your operations?
It would allow us to devote more resources to serving our clients versus serving our regulators, because during exam time, we devote probably at least 10 to 20 staff for at least 2 to 3 weeks dedicated time to exams.
And this is a question, I'd put this one back to you again as Mr. Radcliffe. If you had to estimate anecdotally what you are, or what industry-wide, what percentage of cost of operation are spent to addressing these new compliance requirements? Do you have an idea, if you had to, again, I'm not spitball that right now, what that percentage might be?
That's really tough to estimate. I know we spend well over $500,000 a year now. The actual number is probably higher than that. I've probably underestimated it. So probably $750,000 for our bank
And
alone.
that has significantly increased since the last administration.
Gentleman's time has expired.
I yield.